There's a new and uniquely useful type of trust for families with children with special needs, in particular with cognitive disabilities, that is designed to receive registered funds only, such as RRIFs and RRSPs, and to roll this over from the deceased surviving parent to the trust on the same sort of basis as it would roll to a spouse. And the trustee then receives this money, and their only choice for this one beneficiary with cognitive disabilities is to purchase a qualifying trust annuity based upon their expected lifespan. So instead of the RRIF being designated to the estate or even to another child, because of course the taxes are still owing by the estate, instead of on a RRIF of 1.4 million, for example, taxes owing of 700,000, if the RRIF is transferred to the Lifetime Benefits Trust and an annuity is purchased, if the deceased is 77 and if the child is 36, with an expected further lifespan of 51 years, and if a life annuity is purchased with a guarantee period of 30 years to ensure that all the capital is returned, this would pay $49,000 a year for life, or for 30 years if the child should predecease. Now, the first $20,000 is not taxed because in this case, the child has cognitive disabilities and has a personal tax credit and a disability tax credit totaling about $20,000. So the remaining $29,000 is taxed at beginning marginal rates of 22%, which is $6,380 a year. And over a 30-year period, not at once, this totals $191,400 versus $700,000, which is a tax savings of $508,600. Now, there's very little room to argue against this type of tax and estate planning. Upon the eventual death of that beneficiary child, the trust provisions determine where the residue of this goes, which would of course typically be to his siblings or to their children, but generally it's the same distribution as would be in the Henson Trust for the other parts of the estate that are set aside for the child. This is obviously a very good technique.